very popular topic. My name is Hubert Danson. I'm the CEO of Africa Investor. I'm also the chair of the CFA New York's Asset Owners Advisory Council, representing institutional investors from around the globe with assets under management or advisement in excess of 20 trillion US dollars. And I'm going to be the moderator for this particular session. We're really going to be focusing on the role that institutional investment can play, is playing, and should play as far as Africa is concerned, with a particular focus on all asset classes, but we're really going to be going into some detail on infrastructure as an investable asset class. We're going to be looking at some of the risks, how the risks are managed and contained, the different types of stakeholders, how we're collaborating and coordinating some of our efforts, and how I think many of you have seen over these last 2 days and also last year, the power and the genius of the Africa Investment Forum as that co-investment platform, as that ecosystem, the role that it can now play to evolve and intermediate and crowd in more long-term capital and institutional investment from both the continent as well as internationally. It's my pleasure now to start this panel to invite the President of the African Development Bank, President Adesina. It was interesting yesterday in the President's panel where we got a sort of a bit of a quote from, I think it was President Kagame, which said, "Just do it." You know, that's the narrative that we should really take, the approach, the mindset that we have the opportunity to take within our own institutions. We know the challenges, but we're bigger than the challenges. We know the old narrative, but we are the new narrative. And I'll give you a perspective about this gentleman that is going to come up and give the opening remarks. We share a common friend. This friend happens to be the largest asset owner on the globe. I had the privilege of sitting down with him because we were looking at a few transactions during the recent World Bank annual meetings in Washington. He told me about his encounter with President Adesina. To cut a long story short, he was so impressed, he's made a commitment of $2 billion for next year that will be mobilized into green bonds in Africa. So I think I'm going to borrow another South African adage, and it's called, "It's possible." And I want everyone in this room to recognize that you've been hand-selected to be here because we know that you have the capability to make things happen within your institutions, within your ecosystems. So we are really, as part of the Africa Investment Forum, looking to engage you into understanding and working with us to share that knowledge about making things possible and changing the dynamic. So as President Adesina would say, Africa is bankable, we're investable. Mr. President, the floor is yours.
Thanks very much, Danso, and good morning, everybody. Your Excellency, my dear big sister, Dr. Dlamini Zuma, thank you for being here and for representing His Excellency, President, who could not be here with us today. Please extend our warm wishes to His Excellency, the President Cyril Ramaphosa. This session is about institutional investors, and I just want to start off by saying this is a fantastic event because we work so hard to get all the institutional investors globally to be here. And why is this important? If you look at investors, institutional investors, private pension funds, sovereign wealth funds, and also global asset managers, total assets under management, $145 trillion right now. If you look in Africa, $1.8 trillion of assets that are actually all under management. Well, globally, if you look at it, you find that there is a gap of basically almost $15 trillion in terms of financing gap for infrastructure globally. If we take Africa, for example, we have $68 billion and $108 billion of infrastructure financing gap for the continent. But what's important to pay attention to is that where are the institutional investors investing? Only 1% to 2% of all the global assets under management actually goes to infrastructure globally. And of that, less than 1% of that actually goes to Africa, where the infrastructure deficit is actually the highest. And so some of the reasons that people give for that is risk, political risk, financial risk, market risk, all kind of risk. But Africa is more than risk. Africa is all about opportunities as well. And all, for example, as I said yesterday, if you look at Moody's own report, in terms of default on loans, you actually find that Africa has the least, one of the lowest in terms of default on loans from 2000, I think it's 2003, even up till now. Now, the thing to bear in mind also is, therefore, it's not just about risk, it's all about perceived risk. Africa's perceived risk is quite high for some reason. We need to market ourselves better down, so I think that's the point that we're making about this issue. If you take, for example, senior debt on project finance for Africa, 600 basis points. Africa's senior corporate debt incurs 700 basis points. And this is in terms of the debt spreads that you have. Africa mezzanine debt, 1,400 basis points, right? And so basically, you find that those that have been investing in Africa, who know Africa, don't feel the risk culture that people talk about. They see the opportunities. They know that there's no risk-free environment. Africa is no different from any part of the world. But this is where the multilateral development banks come in. And we have so many of our partners, multilateral development banks, here with us even today. What we are trying to do is, how do we crowd in institutional investors to fill these gaps that we are talking about today? And we at the African Development Bank launched a study, and that study looked at 20 of the global institutional investors and asked them, how do you see multilateral finance institutions? What role can we play to ask you, to leverage your capital to Africa? Some key things that came out of our own thing. First, multilateral development banks and blended finance. We can co-finance a lot of things with you because actually we know the territory better. We know the underlying risk much better. And so you can be comfortable working with multilateral finance institutions. The other part is de-risking, right? We have a whole slew of investments that we can de-risk, whether it's partial guarantee, credit guarantee facility or partial risk guarantee facilities. We have a whole slew of these things that we deploy, and MIGA has a political risk guarantee facility that can help with that. Project development. So much capital. I was talking with David-Borha, the new CEO of the U.S. Development Finance Corporation. We just signed an MOU today to do co-financing together for about $5 billion. And he made a statement. He said, it's not about capital. Capital is there in the United States, but very few deals. So you have in Africa, huge lot of deals, but very few capital, right? And so it's really about how we get bankable projects. And that's what the African Investment Forum and our partners all here are doing, project development, and making sure that we can actually originate quality deals that you can have confidence in. And so how can we move this forward based on the experience of multilateral development banks? First, African Investment Forum, you are all here. It's a transactional platform where deals are originated and transactions can be closed. And that's why you're here. We are all here to help make sure you actually see those deals. Second is, there are examples that work. The African Development Bank has what we call the room to run, where we basically took the risk of our asset book and we actually gave it to the private sector in a landmark $1 billion synthetic securitization thing that we did globally with Marina, with Africa 50, with participation of the European Union to take some of the tranche of risk sharing for us. We have here the EBRD, European Bank for Reconstruction and Development. They have equity participation fund they started in 2016, which allows investors to take about 20 to 30% stake in bank-eligible equity investments up to 10 million euros. The European Investment Bank, one of our partners, is also here today. They have a long-term investors club that's harnessing also things from the private sector. And International Finance Corporation is also here. They have a managed co-lending portfolio program that's actually terrific as well in crowding in institutional investors. So as I wrap up, what exactly are some of the things that I would like us to consider, Dan, so on this panel as we look at it? First, the need for bankable projects and bankable projects. It's very critical. We need to align our risk better. Institutional investors have short-term interest. They want to also have more in terms of returns to their capital. We, as multilateral development banks, have a more longer development-driven mindset. And so we've got to align this issue very well. And also, we got to make sure that we help to de-risk. That's our role, to de-risk, handhold, help, and de-risk a lot of these investments. And obviously, we also have to make sure in doing that, that we standardize everything. Product offerings that we have. It's hard for you sometimes to deal with all of us multilateral development banks. We're sometimes too bureaucratic. Quite honestly, I think so, right? We need to be less bureaucratic. Yeah? You can't have an elephant run a 100-meter race, right? So you need more capital. We've got to be much more agile in actually working with everybody else. And finally, I want to say that knowledge and information sharing is going to be very, very important, and how we price commercial projects. You know, if we underprice, we are not taking into consideration the risk returns profile as we should, of course, we will not be doing ourselves a good service. So finally, let me just say that we have agreed as multilateral development banks to have annual sessions with the global institutional investors, an annual institutional investor session with multilateral development banks. You will see us working quite a lot on development bonds that we will be sharing with you. You will see us working also in developing capital markets that can help to mobilize a lot of it. So there's a lot of things to talk about today. I'm just delighted that you are here on the continent where the opportunities are, on the continent where the projects are, where sometimes the capital is quite restricted. But I think your capital will meet opportunity, and that's what we offer today. Thank you for coming, and we look forward to the conversation.
Thank you very much, President Adesina. You have really set the tone. I think you've given us some very clear and distinct direction. Naturally, I think if we borrow from the saying, it takes a village to raise a child, I think the child here is mobilizing it and increasing institutional capital pools into the continent. So I'm delighted to call on my colleagues, my elite and distinguished fellow panelists and speakers to come and join us to really unpack a number of those issues that you tasked us to really come up with some solutions for. So I'd like to call our first panelist, and please give a round of applause as he enters, Mr. Uche Orji, an asset owner, a sovereign wealth fund from Nigeria. He's the Managing Director and Chief Executive Officer of the Nigerian Sovereign Investment Authority. Next, we're very pleased to have the newly installed David-Borha, as President Adesina mentioned, who is the Chief Executive Officer of the United States International Development Finance Corporation. We have Shola David-Borha, who is the Chief Executive Officer for the Africa regions at Standard Bank, one of our leading Pan-African banks. We have one of South Africa's largest pension funds, represented by Linda Matiza, who is the Chief Executive and Principal Officer at Eskom Pension and Provident Fund. We have Mr. Larry Knox, who is the Chief Executive Officer of Sovereign Infrastructure Group from the US. We have Mr. Richard Ingram, who is the Executive Director for Teachers Retirement Systems of Illinois. And we have Mr. Rob Hertzov, who is the Chief Executive Officer and founder of Africa Invest. Well, good morning, panelists. I'm sure that you heard the very clear marching orders that we had from President Adesina. I think he actually addressed a number of the key issues, but I'll just sort of recap about the types of issues that we are looking to address on this particular panel. There are a number of different constraints that are associated with reasons why institutional investment isn't mobilized into the continent at sufficient quantums. So we're going to be looking at some of the binding constraints and coming up with some solutions about how we can crowd in more institutional investment, in particular into African infrastructure. The second goal for this panel, by way of an objective, is to identify very specific opportunities for collaboration between African institutional investors, pension funds, sovereign funds, insurance companies that are investing, and their international peers. This is a practice that's going on all around the world. Just recently at the G7 meeting, you would have seen that there's a new constituency of G7 institutional investors that have come together to support the goals. We have very clear plans on the continent about how we'd like to drive our own development, take our own views on the risks, and then engage with international partners. So this is something that's going to be at the heart of our discussion today. And again, you know, we want to come out with something at the end of this. So we're going to be looking to create some form of consensus, as President Adesina set out, about the role, the nature, and the characteristics of the multilateral development banks, development finance institutions, regional banks, and development partners more generally, who are, just like us, very keen to see the continent advance in its development at a rapid pace. And then I think ultimately, as President Adesina has said, he's already set out the program. This is not a panel where we're going to have one discussion. The Africa Investment Forum is not a conference that happens each year. In fact, with my personal reflection, I see more happening during the year. There are lots of trips, there are investment meetings, there are bilateral envoys going to actually get transactions moving. So I would really hope that we all do not leave this event with the misperception that this is just a conference that happens each year that we should tick in our diaries. Particularly for institutional investors, I think there's a very important role that we can be playing to collaborate with and support, make capital available, share information on deals with the Africa Investment Forum. So I urge and implore you to go and see what happens throughout the year manifest itself in the forms of the boardrooms. There are a number of very concrete projects that are happening here that perhaps might take away some of our defense when we say there aren't enough bankable projects on the continent, because they are here right now. And I think we should give the Africa Investment Forum a round of applause for that. But to get us into the discussion, as I mentioned before, it takes a village to raise a child, and the child in this case is the embryonic institutional investment pools that we really want to be able to mobilize and increase into the continent. So we have a very different sort of makeup of, you know, personalities and institutions. So I really want to give you an insight into how they view the continent. So I'm going to ask each of them to very briefly introduce themselves and just give us their views on how they see the continent as an investment opportunity, preferred sectors, how do you enter the market. There's lots of different perspectives about the risk return, the risk reward, whether there should be a developmental dividend that should be subordinated to a commercial dividend. All of these issues that we have to really grapple with if we're really going to mobilize capital that comes with fiduciary responsibilities. So I'm going to start with Uche, and if we can go along, please give us your perspectives on how you invest in the continent.
Sure. Thank you very much. And let me also thank the AFDB, President Adesina, and the team for organizing the AIF. It's nice to go from actually talking to coming to a conference that's more like a marketplace where you get things done. So this is really commendable. The Nigeria Sovereign Investment Authority, which is the organization that I lead at the moment, is a sovereign wealth fund of Nigeria. And we invest through three different funds. The first is a stabilization fund. The second is a future generations fund. And the third is a Nigeria Infrastructure Fund. The Nigeria Infrastructure Fund actually is the only one of the funds that's dedicated to Nigeria. The other two funds invest internationally, and we go through funds to invest in other sectors. Let me speak to the Nigeria Infrastructure Fund, because I think that's really the one that's of interest to this panel and then to the rest of the conference. We have a very positive view, obviously, of not just Nigeria, but of the continent. I know there's all the concerns about growth slowing down, you know, South Africa, Nigeria versus the United States, but I see that as a buying opportunity. Our key areas of focus are agriculture, healthcare, toll roads, power, and gas industrialization. There are three things we do. The first is we make direct investments, and by direct investments, we sponsor projects, we co-develop projects, and we invest. We also co-develop projects and co-invest. And one of the things we've done successfully, and we hope to do more of, is the creation of co-investment funds. We've had one for agriculture, and we are working on one now for industrialization. The third thing we do is we actually invest in market infrastructure. And I think this is important, because the reason why Africa has struggled is because market infrastructure is deficient in some places, and therefore trust does not exist. So we have to work on building trust. We have to work on fixing the market infrastructure. One of the things we've done is, and we talked about this earlier, is the creation of InfraCredit. InfraCredit for us is a very interesting landmark investment for the NSI, which we sponsored along with Garantco. And recently, the AFDB invested in InfraCredit. What does it do? It actually allows pension funds to invest domestically. It also creates a platform for us to reduce the cost of capital in the country. We've invested in 6 other institutions that actually address market infrastructure. The way I view the continent is very simple. I think this is a buying opportunity for 2 reasons. Market infrastructure opportunities are being built. Sovereign wealth funds like ours exist. We're a co-investment platform. You come to Nigeria to invest, you co-invest with us. I think that to some extent helps you relax and helps you feel a little bit of trust. The second thing is we're also working on mobilizing domestic capital in the country, which at the moment is significant but not yet efficiently used. And I think this is what makes it really phenomenal with these market infrastructure opportunities. We have big pension funds that are growing. Getting them to co-invest with us and international investors should help us address some of these deficiencies. That's how I see it. Thank you.
Thank you very much. Adam, congratulations again on your newly established institution. Last year, your colleagues were here saying it's coming. By the next Africa Investment Forum, the institution will be properly incorporated and functional. You were looking for deals last year. I'm hoping that you've found deals. Please share.
Well, thanks, and thank you for having me here. As you mentioned, I'm the CEO of the new International Development Finance Corporation, or DFC. And I think the really important thing about DFC is we've got double the amount of capital we had before at $60 billion. And I will note I was very excited about that until I heard about the ADB 200 billion, and now I'm feeling bad. I'm not as excited. But we have very much of a mandate to drive investment into this continent. And not only did we get $60 billion in focus, but we got the ability to invest in equity. We didn't have that before. The significant amount of flexibility to invest in technical assistance. And so I think what you'll see is our focus more and more on the continent. And a few things for us that we believe in. One is partnership. And just recently, in fact, really recently, about 30 minutes ago, with the president, we signed an MOU with ADB. We are both alike in that we believe that it's very important to move beyond just an announcement to specific deals. So we're already starting to align closely on what deals we can do. So I think you'll see us much more as a player in the region. We believe in balance of investment. We'll be looking at everything from large infrastructure projects all the way down to getting dollars to individual people because we believe by creating jobs and growth and stability, that's important. The final thing I'll note that's really important about DFC are what we believe from a foreign policy perspective as the United States, and I think this is important. What we believe is that a strong and sovereign African nation and African continent, nation by nation, is critical to our own success. And so I think you'll see us investing in places where we are empowering the sovereign country. We are empowering local workforce. We are not interested in overly putting on debt. We're interested in sustainability. And so we're very excited about the transformation that's happening in Africa and to play a role in supporting that.
Thank you, Adam. I'd just like to stay with you a moment. There's a constellation of US agencies that you also have the benefit of being able to leverage into the mix. Could you perhaps just give us a very high-level introduction to that? I think Prosper Africa we've heard about.
Yeah, absolutely. So you brought up Prosper Africa. So Prosper Africa is the United States version of saying, listen, we have a lot of tools here. So as I said, me at DFC, I represent $60 billion. Well, what about USAID and all of the aid we give? What about the Export-Import Bank, XM, right? So XM has another $100+ billion. And all too often in US government, we operate independently. We don't coordinate. And so Prosper Africa, by way of example, is an ability to say, hey, not only are we sitting here talking about investment in emerging countries, but we're also talking about major import-export financing. We're talking about aid. We're talking about, so how can we bring all of the power of the US government to bear? And one of the things that I really appreciate, and I'm sure many of you are aware of the Power Africa initiative. And when I think about really great US initiatives on the African continent, I think about Power Africa and driving power. I think about PEPFAR in terms of focusing on AIDS and what we've done there. I mean, those are great initiatives that have grown that I think as an American I'm proud of because they've made a big difference in partnership with our friends on the African continent. And Prosper Africa is the way to say, listen, we've got two examples here. They've worked. Let's expand that out to a lot of sectors, whether that's infrastructure, whether that's women, whether that's entrepreneurs, whether that's healthcare. So it's really an ability to scale much beyond where we started, which was around the energy side.
Okay, fantastic. I think in his opening remarks, President Adesina said we can't have elephants trying to run the whole 100 meters. So I'm glad that you've been able to bring that sort of coordination and cohesion so that we can get better leverage, particularly through the US agencies. And that's probably a good and important lesson to colleagues in this space. I think we saw very early on the G7 tried to look at better policy cohesion, better policy coordination for institutions that are looking to allocate to infrastructure and Africa. So I think that, again, has manifested itself in the direction and the ideals that, you know, the Africa Investment Forum is actually delivering. So that's very, very useful. Thank you. Shola, great to hear your perspectives.
Thank you, Herbert, and it's great to be here. Standard Bank has a very clear purpose, which is to drive Africa's growth. We strongly believe that we have to support the integration of African markets with global markets. We've been on the continent for 156 years. We are the largest bank by total assets on the continent, $148 billion. And we have a presence in 20 markets, which covers about 80% of sub-Saharan Africa, across West, East, Central, and Southern Africa. Our clear focus is making sure that we can tap into the growth sectors on the continent. That includes energy, particularly renewable energy, the FMCG space. Agriculture is a big focus area for us, trade, and ICT. We also bank the entire value chain, so right from retail, small businesses, all the way through to corporates and big infrastructure projects. We believe that Africa is the center of gravity for us. And when we look at Africa's growth rates, medium-term growth rates, about 3.5%, and that masks higher performing economies like Ethiopia, Ghana, Cote d'Ivoire, who are 7% and above. We believe that our organization is rightly placed to support economic activity on the continent. And we really are excited to be part of what the African Development Bank is doing. We have found in all our efforts to mobilize funds, and we financed about 15 billion over that last year, 2018, that having the key stakeholders around the table, helping to share the risks, is what achieves results ultimately. Thank you.
Thank you very much. And I think one of the other additional values of the likes of a standard bank, having transactors in over 30 countries on the continent, is really beginning to address this whole issue of origination and the lack of bankable projects. Now, do we want the average public sector investment professional promoting a transaction, or could we better leverage the likes of some of the investment transactions and structures that exist within probably nearly every single office that you have across the continent, or at least in the headquarters? So I think on the bankable and the origination side, I think that could be quite interesting. But I
will also note, I don't know if you saw their advertising in the airport. You have a great ad campaign.
Thank you.
I told my team to copy it.
Okay.
Is that okay?
Even in the standard bank
Please
blue.
go ahead.
Okay.
See, I have her on record.
Okay, fantastic.
We're happy to partner with you on all those projects on the continent.
Okay, fantastic. Another partnership has been sealed. Now, as I mentioned in the beginning, President Adesina also mentioned the same. It's about leadership. We have a role to play rather than just make our facilities and our instruments available. As individuals and as executives, we have to champion certain new paradigms in the same way that we're all convened here under a new paradigm with a very clear champion with a very specific mandate. Now, Linda, if you look at her title, she's the Chief Executive Officer and Principal Officer at Erscom Pension Fund. But in her former life, she was with Africa's largest pension fund, Government Employees Pension Fund. And that was one of the first pension funds that actually took a real foray when she was a key player in the team into Africa, into infrastructure, maybe you want to just give us a bit of that history and sort of just still share your views where you are now with Eskom about how you see Africa and the potential role and value that long-term asset owners can play in infrastructure development in Africa.
Thank you, Hubert, and thank you to the AIF. It's a great opportunity to be here. As Hubert has mentioned, I've had the privilege of serving for both of South Africa's largest pension funds, first the GEPF and now the Eskom Pension and Provident Fund. The GEPF, let me start there, through the PIC has been making investments in Africa and investments in infrastructure for more than a decade now. In a number of instances, they were the pioneer on a number of projects. However, we tended to invest through funds. So we would invest in private equity fund or infrastructure funds that actually make the investments in projects on the ground. And I think that's a trend that carries through most of South Africa's pension funds, including my current Eskom Pension and Provident Fund. Most of our investments on the continent are done through private equity funds and through infrastructure. On very rare occasions, we get involved directly in projects, and that's usually in partnership with the DFIs and with the banks, where there's an element of de-risking that's taken place, because as a pension fund, you'll appreciate that we are fiduciaries on behalf of members who are from all walks of life, and our objective is to be sustainable into the future so that when they reach their twilight years, we are able to provide for them and for their beneficiaries. And so with that in mind, infrastructure is actually a really good investment for pension funds in terms of the nature of the long term of the investments, as well as the principal repayments that often come with it. So it's a natural hedge against inflation that I think more and more pension funds will be adopting as the awareness grows about the opportunities and as the structures become more available through which to invest.
Okay, thank you, Linda. I'm going to stay with you just a moment because we're in South Africa, and I think from the pension fund community standpoint, it's suggested that nearly 80% of the assets, pension fund assets in the continent, are actually right here in South Africa in terms of quantums. And then there's enabling legislation under Regulation 28 that provides for 5%, from what I understand, a 5% allocation of your assets into the rest of the continent. But I also have come across some very creative individuals within some of your institutions who have said, well, actually, that 5% can actually be extended to 30% because we can also use Africa as part of our international allocation. Could you just talk about what that really means in the context of the opportunity that we're sitting with right now? Because that's a significant mandate that you have, supported by the government. You've just made the case for those assets going into infrastructure. So I'll be very interested to hear your perspectives about how to leverage that opportunity potentially.
There is definitely an opportunity to leverage that allocation. As you've mentioned, South African pension funds are permitted by legislation to invest up to 5% of their assets on the rest of the continent, possibly even more. However, with both the GEPF and the Eskom Pension and Provident Fund, we had invested less than half of that allocation. And I think there are a number of issues around that. I mean, the first is the capital markets that we have accessed, where there isn't in some countries sufficient depth and breadth of the markets for us to build a diversified portfolio in those countries. And so we've invested through asset managers who put together funds that would then put together a portfolio of assets from different countries. And that's been one avenue. We've also invested in the bonds that are issued by sovereigns of different African countries. However, that's subject to investment ratings and other provisions of our mandates that impose certain limits on us. We've also then invested, as I mentioned earlier, through infrastructure and private equity funds. And I guess part of it is just being distant geographically from some of the markets and not having experienced asset managers in country in South Africa, who have that experience of other African markets. And I would venture to say a tiny amount of laziness, I have to admit, on the part of our consultants in the recommendations that they make of what we should invest in as pension funds. The pension funds I've worked for, fortunately, have strong teams of investment professionals, but a number of pension funds in South Africa are reliant on a board of trustees that meets 6 times a year.
Yep.
And so they rely greatly on the advice that's given by their asset consultants. Now, to the extent that the consultants are not doing the research on investment projects on the continent and are not therefore making the recommendations, I think that's why we're finding that gap between the permitted 5% and the actual 2.5% that persists.
Fantastic. You've raised some pretty interesting issues there. In particular, I heard two sort of stand out. One is the underdevelopment of the capital markets. And I think this is an ongoing conversation with development finance institutions who are getting to the point, from my interpretation, getting to the point where they realize that no matter how much development assistance we put into other technical areas of the economy, unless the capital markets are functioning, it's almost like putting it into a perforated bucket, because those returns won't come, because a number of the mandates do not actually provide for direct assistance or direct programmatic assistance to capital markets. And we understand through the African Securities Exchange Association, they're looking to pioneer that development, because that's a critical piece. President Adesina mentioned it, MDBs have a great role to play in that particular space. The other point that jumped out is this recurring issue of consultants. And the fact that, as you mentioned, some of the asset owners, some of the pension funds have small teams. You can't rely on a small team that doesn't necessarily have pedigree or a depth of knowledge on certain asset classes. And as a consequence, won't be able to discharge their fiduciary responsibility and therefore just have to rely on the consultant. Whereas sometimes you have a consultant that doesn't necessarily have the geographical knowledge or the product expertise. But one of the things I found, very interesting, particularly from a leadership standpoint, was that a number of the pension funds in South Africa actually came together and said, we actually control what the actual asset and investment consultants do. Perhaps as the industry, we should perhaps be engaging them on a different level with a slightly different mandate that actually forces them perhaps to look at more research and equipping you and empowering you as a community to be able to take those decisions. I'm going to move to Larry now, because I know that you spend a lot of your time selling the advantages of the continent to sophisticated investors. Grateful for your view.
Thank you, Hubert. First of all, thank you, and it's an honor to be here and in this esteemed group, so we're proud to be here. My name is Larry Knox. I'm the CEO and founder of Sovereign Infrastructure Group. And Hubert, our business model will tie in directly to what you're saying regarding the capital markets and how do we utilize those to actually drive capital. So within the multilateral community, there's been this strong push to figure out how do we move from billions financed annually to trillions financed annually. The only way you're really going to get there is through those capital markets. So our thesis of the case and our investment policy and the way that we approach the world and how we analyze risk and make our investment decisions is very fundamentally simple at the end of the day. So our business is out of the U.S. primarily, and we look to expand internationally, primarily into the continent of Africa to bring investments here. And our focus is on infrastructure. But the infrastructure and the way that we view it is we primarily view it from a credit perspective. And our fundamental business is out of the U.S. capital markets and the U.S. municipal markets. So in the U.S., the way that we finance infrastructure there is primarily through the U.S. capital markets, the U.S. tax-exempt markets. And there, water is water, for example. So if you're going to finance a water project in the city of Chicago, or you're financing a water project in Johannesburg, from a credit perspective and from a fundamental engineering perspective of building water treatment facilities, finishing the water, delivering the water is the same no matter where you are on the globe. So from a credit perspective, you're the same. Where the fundamental analysis really has to come in then is understanding the macro and microeconomic political risks, the regulatory risks that exist in that environment. So within the U.S. capital markets, it's a $4 trillion market that understands infrastructure, understands credit, but what they do not understand is the emerging markets, or as we like to call them, growth markets. They don't understand the various vagaries associated with that. And so through our partnership model, what we do is we work closely with the multilateral community, very specifically the African Development Bank and the AIF, to help navigate that. So what we do is we create kind of the corollary, if you will, of the U.S. muni markets by working with the African Development Bank and the various multilaterals on the continent to kind of create that same environment from a regulatory risk management standpoint to understand the regulatory as well as the political risks of the areas that we invest in to create products that the U.S. pension markets, this $4 trillion market, can really understand and be able to translate that from an intellectual capital standpoint or from a technology financing standpoint to say credit is credit. We'll work with the African Development Bank and their team to manage the political risk and to help drive that forward. And what we found is that that argument holds true because it's a technical argument that is very sound. But more importantly, it gets back to your conversation about the consultant community. The consultants, what they do is that they also understand that model. So it helps lower the barriers to entry, if you will, for being able to adjust and gain allocations from these institutional investors to start to translate those capital investments onto the continent.
Okay. Thank you, Larry. I just want to stay with you. I mean, that story, I mean, it's working. Help us understand, during Climate Week around the UN, I think there was about $30 trillion worth of asset owners that were convened. And as it related to infrastructure, the suggestion was there's a very clear new normal in terms of asset owners allocating to infrastructure. And the suggestion was that that new normal is 3 letters, E, S, G.
Correct.
And the majority of infrastructure transactions and projects that are not structured to be ESG compliant miss an opportunity to access a 20 trillion plus ESG driven pool of capital. Does that come across in
it does come across, but the way that we view it is slightly different. And I'll go back again and kind of use the US markets as a corollary and define what we do as opposed to kind of municipal infrastructure, just based on the US side, as more importantly as international municipal infrastructure financing. So from an ESG component, largely the US municipal market is 100% ESG and SDG because those projects go to support the economic development and the build out of US infrastructure. So in the US, and those investors understand that and appreciate that this is sustainable. It does create developmental impact. The developmental impact that we see there is in kind of the poorer areas of the United States, Gary, Indiana, for example, Puerto Rico, who get a chance to benefit from these areas. So from a broader perspective, we have been able to successfully argue and work with several of the rating agencies to obtain a green evaluation for our structure and our methodology that does say that by working with the multilaterals and the African Development Bank and the like, because everything that they do has to conspire and meet the requirements of the ESG and the SDG goals as defined by the UN, that we are therefore naturally ESG and SDG. So therefore, infrastructure investments that we make on the continent, infrastructure investments that we make globally are deemed ESG, SDG by default.
Fantastic. So could it follow that a more deliberate and explicit reference to ensuring that the projects that we develop on the continent are ESG compliant, it should follow that that would increase our probability and access to institutional pools of capital?
No, absolutely. Absolutely. And it's about changing the narrative, right? And I think earlier we were having the conversation about it. For a long time, the narrative has been developmental focused, right? We focus on the risk. Instead, our narrative is, let's talk about the returns, right? We understand risk. Let us manage that. And we're trusted to manage the risk. So we can then steer the conversation to the areas that they really care about, which is, what is the return?
Yep.
And what is the return profile that's available to them?
Fantastic. Thank you, Larry. I mean, the risk issue, I think President Nishina again mentioned it at the beginning. It's probably more to do with perceived than it is actual. And I think, Richard, when we first met some years ago, and we were all enthusiastic. We were on the panel in Atlanta amongst a number of pension fund colleagues. And someone in the panel mentioned that it's probably perceived to be a very exotic investment to even allocate to Carlisle. Now you're advocating Africa. But here you are today. So please tell us your story.
Thank you, Hubert. Before I do that, though, I want to take a second, a personal privilege. I'm sitting here as a person whose very unskilled rugby days are far in the rearview mirror. But it's a real privilege for me to sit here and say to the continent, and especially to South Africa, congratulations and well done, Boka. Truly awesome, in so many ways. I'm so happy for you. Yeah, so here we are, right? And this is my third trip to Africa this year. All three trips have been due to the support and the friendship of the folks at USAID and the MEDA initiative that USAID has created together with NASP in the US. I would not have been able to come without that support. And what I learned immediately is there's no substitute for actually being there and experiencing it and breaking down the walls that do exist and understanding of what the opportunities are. And I was describing to folks earlier, the first trip was curiosity. The second trip was expectation because I'd seen in the first trip what the possibilities might be. The second trip was starting to do the work of identifying who the partners might be that we could work with. The third trip, this one, was emotion. And I really found myself as we were approaching to land, feeling a very emotional tug to, oh, this is, I'm coming back to a place that's very special and that I've come to really appreciate and love. But the motivation, we can talk about all sorts of, programs and all of that, but Linda really referred to it. We're sitting here as fiduciaries with a responsibility to our members to provide them retirement benefits for as long as they live. And that means, in order to do that, we have an obligation to identify what the best investment opportunities are to ensure that future security for them. And the question that has been dancing around in my head and that I'm working through with my board and my staff and other stakeholders in Illinois is how can we say that we've done our fiduciary duty if we have ignored an entire continent? I mean, think about that. I mean, there's very little activity up to this point, whether it's with consultants or pension funds or anybody, that is focused on Africa. So to begin to break down those walls and to be able to bring stories and reality back to the folks in Illinois is critically important. It's a hard struggle. There are all of us in the United States. I can speak to us with a certain level of expertise on public pension systems in the United States. We all operate in very different local political environments, but we all have that same core fiduciary responsibility. And the inertia that we're overcoming is the natural human desire to stick with what you know and what's familiar. And you have to be really intentional breaking out of that, because what I tell folks is if you're not doing something different, by definition you're going to be average, and none of us want to be average. So, I have viewed this opportunity as that quote-unquote something different that we could pursue to make us different and make us more than average.
Fantastic. I think that's the point. We have to do something different. And besides, as you mentioned, all of the different instruments and all of the different support you could have got from some of the agencies, it was, and I won't belittle it, I'm just saying it was as simple as subsidizing a trip for you to come and see the continent for yourself can make a huge difference. And we exist in a continent and an ecosystem of development finance and development partners that actually have trust funds and lots of technical assistance budgets that could potentially be applied more to this particular constituency that would have a very significant impact. I know from the MEDA experience myself, we've worked with them for a great number of years. As you know, there are a number of allocations that have been made as a consequence of USAID funding just travel or subsidizing travel and accommodation. Now, I think doing something different, not to be average, means that a number of our development partners should potentially look at those budgets that we have, that we fly people to conferences, because you're a $56 billion pension plan. So typically, we might look at you and say, from a development lens, well, if you manage $56 billion, surely you can cover the cost. But the catalytic effect of being able to just subsidize your trip could unlock more than we're protecting, because we're not prepared to think or do things a little different. So I'll move on to you, Rob, because you also advocate some of these simple but innovative approaches.
Yes, the mission for Invest Africa, my business and my other Africa-focused businesses are very simple. To sensibly evangelize investment in Africa. And investment is more than due diligence, it's trust. And when you speak to international investors, which we do every day, to institutions, ultra-high net worths, and family offices, and we've done 182 meetings and calls with family offices this year alone to evangelize Africa, it is down to trust. And you need to, it's the truth, the whole truth, and nothing but the truth, so help me Africa, in this case. And when we look at Africa and we try and explain the continent to investors overseas, many of whom, and in America, I must add, a lot of whom haven't been to Africa and really don't understand it, because maybe they didn't take geography at school.
No, it's a
we
real
need
awful.
it is a problem. We need to be very clear and try and synthesize the opportunity. And how we do it is we have 4 metrics: optimistic, cautiously pessimistic, and pessimistic, for countries, for sectors, and for opportunities. And when we explain Africa, 54 countries, we try and synthesize it into, we believe, and this is our view, there are 16 countries in Africa that are investable, of which I would invest my own money in 8 of them. Now, I know you want to know which they are, but we'll leave that for later. So it's very simplistic, but it gets straight to the point, and this is countries and sectors.
Fantastic, thank you. I think I'm going to move on to Adam now, because I know he has a hard stop, and we're glad that you're here, but we know you have to leave at 12. But from the asset owner's perspective, okay, we've mobilized all the pools of capital, everyone's on board, we're ready to go. Fundamental question is, are there the assets? Are there the bankable projects, in addition to and supporting what the AIF are driving? And there's this recurring suggestion, Adam, that to get the pension funds comfortable to be able to allocate in the first instance, one might look at some concepts that have proven successful elsewhere in the world. And those concepts are described as asset recycling and asset refinancing. In other words, the suggestion is greenfield risk is probably too high for the classical, first time at least, or even more seasoned institutional investor, pension fund or sovereign fund. And a lot of these assets that have already been financed sit on the balance sheets of some of the development finance institutions and banks, and that selling down a portion in terms of an asset recycling could actually create the sense of alignment for the risk return reward that some of the pension funds are looking for. I was just interested to get your view on that.
Yeah, I think that's a fair point. And I want to hearken to a couple things that were said, just in terms of pension fund or other interest in Africa. And just to give you a sense of dynamic and how I think it'll evolve. I think one of the issues you have if you're a pension fund in the United States with a lot of capital is you've been doing pretty damn well in the United States. You know, our stock market has done very well. And so when you talk to, and I've had this discussion both with pension funds as well as with private equity firms, you have a question around why change or why educate yourself. And so, but let me give the counter to that we're talking. One of the things I find is very well correlated simply to investment returns is the amount of opportunities there are versus the amount of capital there is, right? Between that and growth rates, those are probably, if you want to look at a vintage of a private equity firm, where they do well is when people are not as interested in a down area. And so I think one of the things, and your approach could help to get pension funds, et cetera, but forward-leaning pension funds are going to recognize the fact that you have a dynamic here with a lot of opportunities and not enough capital. That's a good dynamic. You mentioned before in your discussion around growth rates, or I think you were talking about growth rates, Ethiopia, Ghana, other places. Where do you see 7% growth rates, right? I mean, that's how it used to be in China, and that's tapering off significantly. So those two opportunities, I think, are critical. And if we're going to get investment capital to flow from the United States from a pension fund perspective, there has to be the reason to do that. And that's been what's held up a little bit. As you said, when I talk to private equity firms, there's a barrier mainly just because they're doing really well right now with what they're doing. Now, I do think that will shift over time, and I think making the argument between growth rate and that now is the time, because there's not enough capital, is the right way to go.
Okay, fantastic. And parting shot, I know you're just about to leave. We really want to understand how we can come out of this with a couple of recommendations about how the MDBs and development finance institutions can work more cohesively and coordinate. What would your recommendation be to your colleagues, having gone through the Prosper Africa experience, seeing an potential inefficiencies turn into a coordinated tunnel of funds type model? Everyone knows at which point to come in. They're brought along into the process. How would you evangelize that to the global multilateral development banks and development finance institutions to be able to get a better sight of the unlocking the opportunities on the continent?
I think all too often, sometimes in the MDB space, some MDBs have looked at each other as competitors for deals. I think that's a mistake. And I think there's so much to be, we all have the same aim, right? We want to drive development, we want to drive jobs, we want to drive growth. We have return expectations. And as I said, we're not in a scarcity of deals aspect here. And so what we're going to orient a lot toward, and it's a reason why we signed the MOU with ADB, and why I think you'll see a lot more of this, is partnership here. I would rather, I mean, look, we could write a $1 billion check ourselves, no problem. But I'll tell you, I'd much rather write a $200 million check with 4 other allies, because together we'll make a difference. And so I think you'll see a little bit more of what has happened in private equity in the United States too, which is more partnership and syndication with MDBs and working together. The other thing I'd note is focusing on different stages. So one thing that was mentioned is kind of getting products or projects to a viable financing stage, right? And so where can we come into play so that we can go and deliver it to Illinois teachers? We can invest in technical assistance now to get that project to a bankable place, right? And then we're catalyzing so that we can take, because what is he looking for? He's looking for predictable returns, predictable cash flows. He doesn't want to go in and frontier evolve a deal. That's not his stage. But that is what we can do. And then we can leverage private capital. And so I think getting in early, shaping these deals together will be really important so that we can turn it over to the private sector and advance those flows.
Thank you very much, Adam. So in the opening remarks then, when President Adesina described the space as sort of elephant infested in some respects, I think it comes back to the old adage of when elephants fight, it's the ground that suffers. So, we really want to make sure that we get everyone working on the same page in a coordinated way 100%. So we can unlock that benefit. But I understand you have to leave now. Thank you very much
Thank you, guys.
for joining us.
I apologize I have to leave early. I've not done this before in an event, so excuse me. But I'm very happy to be here. Thank you.
Thank you. So Uche, I'm going to come to you, and then we're going to go for a round of questions. And again, I'm staying with this bankable and bankability sort of issue in terms of where's the pipeline. We've got enough capital, we've got enough development finance, we're overflowing with instruments. People have been encouraged to optimize their balance sheets better, to crowd in institutions like your own. But then you bump into this thing in the market, which is very controversial, but people keep repeating it. Unsolicited bids, the procurement time to actually develop a project, pent-up private sector infrastructure project development capacity, not being left alone to develop a project where they have expertise and getting caught up in a procurement process. Just tell us your views about that, because we understand we're living in a different time now. We have to think differently, we have to act differently, and we are seeing unsolicited bid transactions such as Natigal in Cameroon that's recently been done happen. Is there a best practice that you'd like to see that would help you and colleagues be able to get involved, a very transparent, unsolicited bid framework that works? Do you think that would help crowd in your capital?
Thank you for that. I think that's a very interesting question, because one of the first things we did at the NSIA was to write a policy for unsolicited bids. And that's really important, because if you don't have a proper framework around it, you could get easily overrun. And this is Nigeria, where deal development, deal solicitation is like how much time do you have in the day, right? People will just keep putting deals on your desk. But there are quite a few issues, first of all. We need to separate deals that are prepared from deals that are aspirational. And most of what I have are aspirational deals that turn up. The second thing is, in preparing your deal, you need to be able to do the work, a lot of the work yourself. You don't just bring an idea and expect the NSIA to pick it up and run with it. And so with that in mind, we are looking for strong sponsors. We're looking for experienced sponsors. We're also aware that not every time that the sponsor has the capital to actually develop the deal, right? So we might be able to look past that and invest in developing the deal. So we dedicated 1.5% of our infrastructure fund to deal development. But we also are very careful because that's not sufficient, right? Because that gives us a pool of about 10, 15, maybe $1 million that we can spend. A proper deal you need to develop costs between $2 million to $5 million, maybe 10. And so we can't do more than 3 or 4 of those. So one of the things we've also done, and one of the things we're discussing earlier, Hubert, was putting that into a fund in itself. And so we're looking for people to partner with us in creating a deal development fund. NSI is doing it. We also know that there are other funds that are available to do that. And so we're trying to pool resources together, create it either as a fund or in some cases an entity. So upon closure, we can actually either exit or roll that into the final deal. So we're working on that with many of our partners to try and create that and make it work.
Can I just interject and clarify? You are talking about a deal that's a pre-financial close situation.
Absolutely.
Early stage. This early stage greenfield pipeline that we say is not investable, you believe it can be made investable?
Sure. So very early stage, but then it has to be within the sectors that we're interested in, right? So we're very clear about the sectors we work in. Agriculture, healthcare, gas industrialization, toll roads and power. These are the 5 sectors. But again, isn't enough capital. So, when you come in and I say, well, the door is closed, portfolio is constrained, that's actually a fair answer because we haven't got a huge amount of capital. But we're looking to see how to pool other resources and create that into something significant that can help. Having said that, you have a better chance if you already have some of your own skin in the game, you also have strong sponsors behind it, then it's easier for us to participate. We will ideally not want to be at the feasibility stage. Concept development, towards the end, then that's fine. But early feasibility, you should be able to do that by yourself. If you can't do that by yourself, maybe you should get a job. I think that's actually a little bit easier. And so quite frankly, and I'm being very brutal because I have no filters, but this is the fact of the matter. You can't expect us to do that work for you. That's not what we do.
Okay. Thank you, Uche. I hope you've got a lot of business cards because I have this suspicion that you're going to be mobbed after this because there's a lot of opportunity that you've just put on the table. But yeah, opportunity should now extend to the floor. So I'm going to open it for some questions and answers. So please, we have a hand there. So please identify yourself and who you're directing the question to. I think we have time for 3 questions. So we'll take the first 3. Okay. 1. Okay. Yes, sir.
Good morning. My name is Andrew Slater. I am an independent advisor to African institutional investors, in particular the pension community. I'm also English, but was quite happy to lose to South Africa a couple of weeks ago. I think I win both ways. More a general comment to make rather than a question. If the returns are there, pension funds, be they in Africa or outside of Africa, or hopefully both together, will invest in African infrastructure. I know that firsthand from my conversations with the African pension funds. The sentiment is no longer, should we invest in infrastructure? It is, how do we invest in infrastructure? But I will challenge slightly that the answer comes from the asset management industry and the product design. I think it's going to be much more organic from the pension funds, and I would posit as the model to follow is what's happening in Kenya with KEPFIC, which is over 12 pension funds in Kenya coming together voluntarily to invest in infrastructure projects locally in Kenya, that model can work worldwide.
Okay, thank you very much. You'll also note that model, the KEPFIC model, I think originated with the pensions infrastructure platform in your country. So it's an interesting trend that seems to be happening. The second question, please. Can we have the microphone to the speaker, please?
I think the gentleman over there.
Yes. Okay, where is that? Okay. All right. Next. Yes. Can we have the question?
My name is Samuel. I'm a great Nigerian. It's good to see very good crowd of Nigerians here. My honorable, my president, you are doing a good job, and we Nigerians, we love you. Uche, my brother, you are doing an amazing job. My question is very simple. We sit down all the time with great players, people that are extremely excited to come into Africa to help us create jobs and reduce poverty. But the challenges we're having here that have been said and on and on and on and on, it's about bringing projects to bankability. It's an issue we have, we don't know how to solve it. The government have good visions, they have good ideas, we the local partners, we are doing our best, but sometimes we have that challenge to put resources together to bring projects into solid bankability. I know you sit down with governments all the time. The government have a lot of good visions. The African governments are making a lot of money now. If they can help us, when they bring deals to us, if they can put it together properly, then when we sit down with lenders, either from China, Turkey, UK, where I base, Rob, it's good to see you, that will help us get deals done that can help create jobs, reduce poverty, empower our women, but to tell our leaders to leave a legacy for not only this generation, but for the generation to come. Thank you.
Thank you very much. The microphone could go to this gentleman over here, please.
Thank you. Good morning. Mima Nedeljkovic, Chairman of Africa Global Schaefer Group. We've been investing and developing in Africa for over 60 years at this point, so it even predates me. Wonderful panel. Hubert, thank you. President, fantastic to finally have the deal rooms on the continent. Question I have is, on infrastructure, long-term investments, and maybe this also particularly hits it when you talk about the pension funds, how do we de-risk the political risk? You're making deals that are infrastructure, that are heavily government focused one way or another, regulatory side. How do we make and close on the deals that are 20, 25 years, be they power, whatever infrastructure deal might be, not knowing the change in the political environment? Thank you for that. It hasn't been asked. I wanted to ask it. Thank you.
Thank you. So we're now going to just offer it to who wants to take, and you can just take your pick of the questions. Rob, I see that you and Richard would like to
I'll just, first on the KEPFIC comment, that was one of the meetings that I took in my second trip, because I can see a distinct opportunity for U.S. funds to work with local partners, no matter how you describe them, particularly if they're a fiduciary that have similar responsibilities as we do in the States, to be able to go to my board and say, the people that we're working with are in the exact same place that we are. The wise guy in me, when you ask the political question, are you talking about Illinois or Africa? Because honestly, the political risk is balanced on both. But I think that the simple answer on the African side of the equation is, obviously, I think you first want to be investing in projects where the demand is already in place for them and it's not speculative. So that that sort of gives it a life of its own. But as my friend here said, you pick the right countries too. You cannot be scattershot in your approach to it.
Yeah, just one little comment. My Rwandan friends describe Switzerland as the Rwanda of Europe. So pick the right countries first, and that de-risks the political situation.
And I would add to the political risk aspect to it. All jokes aside, it's true. I mean, think about the political risk. It is fairly balanced. One of the aspects, if you think about like on the U.S. side, because of the regulatory regime, it's a very transparent and very straightforward regulatory political risk. And part of that is highlighted through the transparency through the capital markets that we have that has an SEC that oversees that. When you look at that on the emerging market side, it really does not exist, because what you're trying to do then is look at 54 different individual nations to try to create a capital market solution for each one of them. That is not our approach. What we look at it is that the multilateral community acts as kind of the de facto regulator through their work and their multilateralism and having all the countries being members of that. So what we then do, and we think that this is one way that you can de-risk the political side of it, is by working in the partnerships with the multilateral community. They bring that transparency, they bring that standardization to the opportunity, which kind of gets you back to an equal playing field. While it may not be Illinois, it is Rwanda. However, there is a level playing field there, and you can now make an equation between the two and get to a risk-neutral kind of analysis, which gets you back to a return question.
Okay, just on the KEPFIC, I'll come to you as well, Uchi. The KEPFIC is essentially a constituency, it's a consortium of Kenyan pension funds that had some technical support from the World Bank Group to come together as a national co-investment platform, as a key interlocutor for international pension funds to be able to co-invest alongside a collective of national pension funds. And I think that's a model that we have seen proven in other parts of the world, and I think it could certainly lend itself to unlocking a lot of institutional capital country by country. But the AIF is very well placed to be able to implement that on a sub-regional and or continental level. And I think that's a thought that we really must continue to allow to percolate. Uchi?
I think to the point about political risk, and I do have a view here. My view is when you talk about political risk in Africa, you're basically talking about countries without the right institutions, be it democratic institutions, or be it market institutions, or be it legal institutions. Because, England is going to have its third election in 5 years. Mm-hmm. 2 referendums, and nobody talks about political risk. Okay. And the reason is because there are strong institutions, right? So you have stable democracies now in some of the countries in Africa. So why are we talking about political risk? So let's talk about the context of institutions, and this is really what we need to address, Mr. President, is making sure that the institutions exist, that people can trust them. So that's the first thing. And the second thing is tools. There are many infrastructure projects today that have all the right tools that enable investments. Partial risk guarantees, both from the AFDB, from the World Bank, those will help. The final thing for me in addressing this is partnerships, right? So when you co-invest, and this is really wonderful, it's also back to the institution building. Many African countries have gone into creating sovereign wealth funds who also co-invest with you. Those are the things that will help, in my opinion. So I think of the 16 countries, I believe, institution building across those countries is paramount. But then there are many tools available, from insurance tools to partial guarantees tools, and then there are partners you can work with in those countries. That's how you address it.
Thank you, Uchi. I'm going to stay with you because we are out of time, but I'd like to give everyone an opportunity to give us these recommendations. We want takeaways from this to contribute towards the Africa Investment Forum's roadmap. And one of the key tasks that we were given is to give some concrete suggestions or practical initiatives that we as members of this panel and the asset owner community or key stakeholders in the community would put on the table that the AIF and our own institutions could collaborate with to accelerate MDBs and development finance, to accelerate institutional investment into infrastructure. If you just give us your recommendations as you go, and then we'll bookend and close out with Rob. Thank you. Uchi.
Sure.
Sorry. I bored him so much.
No. I think that's always a question. Yeah.
Yes. 2 recommendations for MDBs.
Sure. So in terms of the recommendations for MDBs, I was just responding to a different question. I think some of the things we've talked to are actually applicable. The first, obviously, and I'm going to be referring to something we're working on, is actually creating co-investment funds with many of these MDBs. And it's a shame Richard left earlier, but that is something that I think will help. We also bring in a lot of ourselves together, because I think the sovereign wealth funds that you have in Africa have a role to play. And we've pulled ourselves together from Angola to Nigeria to Ghana to Morocco to all the countries that have these institutions to say, look, we as a platform, we as a group are good co-investment platforms that you can work with. And I think that makes it a little bit easier to engage. Now, obviously, many of us have different mandates, but I think that really helps. Now, for the MDBs in general, I think when I hear people say, well, there's capital, but we can't find opportunities, I think you're not talking to some of the right people. We are on the ground, and I think if many of you are looking to invest, and even if it's just to give us a call and ask for advice, that is something that I think we can help you with in making sure that at the minimum, you are getting access to the right pool of assets or investment opportunities that will help. So we're here, we're really open to working as closely as possible with the MDBs in ensuring that we channel the capital to the right opportunities.
Thank you. Shola?
Yes, if I can just quickly comment on the fact that I think regarding mitigating political risk, the point about having the right partners cannot be overemphasized. Having partners who share the same values with you and who understand the local markets. You can't do without that. And what has worked for us at Standard Bank is really making sure that you understand what each of the stakeholders are looking for. So, what are the investors looking for in terms of, an attractive return? They want, liquidity. They want to make sure that they get their funds back, and are able to fulfill their fiduciary responsibilities. Doing a lot of background work and actually bringing together the different stakeholders we have found invaluable. A lot of the work has to take place before the actual forums that bring them together. But if you do the right work, you'd be amazed that the right solutions are drawn up because you've got the key stakeholders and you get the right structures that fit particular projects. The last thing I would like to just chip in before I round up is just the importance of African governments doing the best they can to make the projects as attractive as possible. This involves being pragmatic about commercial solutions, not emotional, making sure that they're cost-reflective tariffs. Many times to build infrastructure in Africa, you actually have to first build infrastructure because the roads can't support the vessels or the ports aren't deep enough. So allowing investors who actually first need to build some infrastructure to take tax credits on that, will help build the investment case. So I think that's such an important enabler, especially at the early stage, to attract investment. Thank you.
Okay, thank you. Yes, agreed. And I think that's one of the key findings from the African Union's 5% agenda. And the suggestion was that there was a misalignment between the expectations of the public sector when they develop and structure a transaction linked next to the investment criteria and investment policy statement prerogatives that sit with the asset owners. So within the 5% agenda, the suggestion is that the asset owner community makes itself available and makes its expertise available to governments much more than it does today to be able to assist structure, or at least as governments put the programs together, they're familiar and aware of the investment criteria from the potential asset owners that they would seek to crowd into the programs going forward. Linda.
I think what we haven't done so well as South African pension funds is to collaborate more. And the Kenyan model is an excellent example of how it can be done for us. We do have some industry associations, but I guess they haven't been as deliberate about committing funds to infrastructure or to other investments in other African countries. And that's a focus that I think we haven't had so far. And perhaps with the right kind of technical support, yes. It's an initiative that I would certainly be happy to be on the board of.
Fantastic. Thank you. Larry?
Thank you. It almost sounds like a cop-out, but I think that the takeaways and what we're doing is very similar to what the African Development Bank has done, along with the African Investment Forum, which goes back to your point earlier, creating strong institutions. Right? Those strong institutions allow for standardization, transparency, and efficiency that allows that capital to flow. It's very hard for institutional investors to analyze 54 countries, of which 16 of them may be investable, of which 8 may be selected. So how do you create that environment? It is what we're doing here and why we're here on this stage, which is to create strong institutions that give the regulatory environment that corollary that allows that capital to flow through.
Fantastic. I think that's a brilliant point because the data that we've historically been putting into the market, we put out some great reports. We spend millions, tens of millions of dollars each year on reports. But when you analyze them, I'm not sure how many of them actually talk about the investment return, the risk-reward profiles.
And if we're looking to talk to a financial sector, a sophisticated institutional investor, perhaps we might start looking at different content. And that's definitely an area that I know that there's a lot of budget within our own institutions as well as development partners. Richard.
I think my idea is something that we've already started talking about, sort of amongst our friends with USAID and others, is, how can we bring Africa to the States? I mean, it's not possible for the people that should be here. You'd like to think everybody could get here, but they can't. So what can we do? What can we put together in terms of sort of a roadshow, if you will, of the key organizations that we can visit with some of the key state systems around the country, and let them know that there is this infrastructure of support for investing in Africa that they may not appreciate or know. So I think that's what's necessary.
Are you suggesting take the AIF on a roadshow to the US, which is?
It's Chicago.
Chicago. Okay, all right, there we go. Territoriality. Rob?
Hubert, the problem with going last is you feel like all the ideas have been taken, and I had only two things to say, and one just went right here, and that was reverse missions. Let's make sure we get the South African and African and Nigerian pension funds to America, because I know it's very difficult for you guys to travel. You have to get permission, and it is complicated. And the second prescription is the MEDA program by USAID. I think it was a very small amount of money, has been immensely effective, extraordinarily effective, because it has got people like Richard here to visit, to put his feet on the ground, and slow education, 2-3 years of coming back and forward, pays off. One quick example, thank you to USAID, is Chicago teachers have now invested $20 million in Africa as a result of that program. And just to finish up, Hubert, I want to thank you on behalf of the whole panel for excellent moderating. In fact, some of the comments you made were some of the prime comments today, so congratulations.
Thank you. Well, I'm glad the check cleared, but I'd like to give the floor to President Adesina to close us out.
Well, thank you all. This has been a terrific panel, and I think that there's a lot that we have learned as MDBs from here, but just a couple of thoughts from me on this as we close. First is that it's clear that from growing from billions to trillions, you don't go to where the billions are, you go to where the trillions are. And so the multilateral development banks are going to be working very closely with you all to be able to tap a lot of those trillions into where we believe they need to go when we talk about sustainable development. The second one is that there's quite a lot of diversity. We've had quite a lot. You have small institutional investors, you have large institutional investors, you have those, like you were saying, that you invest through other asset managers, you have large ones that can actually, they understand better, they have the capacity, they can take on more risk. So one has to understand that differentiation as we try to go forward with regard to that. The third one is that, and this one is just for the pension funds and sovereign wealth funds of Africa. You see, a sovereign wealth fund is a sovereign wealth fund of a country. And when you have a lot of sovereign wealth funds and pension funds of Africa invested outside of Africa in money market instruments that are earning negative real rate of returns, what's that? And why will our sovereign wealth funds become the sovereign wealth funds of others? You lend those monies there, then the African countries go back to go and raise Eurobonds. They borrow their money back at high yields. It's their money, right? So I really think it's time to change our perception on that. If we are not investing in the continent, why do we expect anybody else to be doing that? And if you have a pension fund, which is supposed to be investing in the, pensions people as long as they live, hopefully they live long, and let's assume that you are even earning a high rate of return on that. And then you give them annuity payments for the rest of their life, living life. But they have to come back to a place without electricity, without water, without sanitation, without hospitals. That's a miserable retirement. And so I think there needs to be quite a lot of conversations together with the pension funds in Africa and sovereign wealth funds about how we can get you to invest more. Yes, one can do a lot in terms of allocative decisions that you make in terms of the limits that you're given, but you should have, I think African pension funds and sovereign wealth funds should have more faith in Africa than they currently have. The other one is the issue of capacity. We've had it throughout this panel, and I want to say that the multilateral development banks will work with you in this issue of capacity to be able to understand the projects, to be able to understand the risk, to be able to price things properly and all of that. And so I think one way to do that is to have some of the pension funds, we can actually send some of our staff to be based within your own operations to understand how you operate. On the other way, also to have some of your staff based within the multilateral bank, development banks to operate, see how we operate and understand our context better. I think communication is a fundamental thing we have to say. A lot of what we talk about here, it's really not so much about risk. I think it's a lot about high risk aversion, most of it that's driven by risk perceptions. I'm not saying they are not underlying risk, but they are not different from any parts of the world. But Africa needs to communicate better, successful projects, successful deals, and that's what this kind of forum does for you. When you walk into a place, you see deals of $38.7 billion done in terms of investment interest. You got here, you did $67 billion going into things. These are things that you will not see quite naturally. And I think it's important for us to get the communication narrative very, very right. And I think that just to close in terms of the point about the multilateral development banks, I don't expect institutional investors to come into early stage greenfield projects. I think that's what you were saying. Here we can take the risk, construction risk, where the risks are high, we can take all those risks. But then later on, as the revenue streams are much more steady, we can do a relay thing. We can actually transfer some of those back into the institutional investors, and then you can take it off from there. I think it needs this kind of organic collaboration, discussions, partnerships that we have seen on this panel. And I would like to propose that this be a standard procedure, standard thing for us at the Africa Investment Forum, that we bring in the world of global institutional investors and also the ones of Africa into here, into the boardrooms. This is the place to be, and I like the point that you made. 54 countries. You need economies of scale and economies of scope in investment. And the Africa Investment Forum platform offers you a whole slew of projects that you can actually do that will build your confidence in investing in Africa. So thank you so very much. We look forward to working with all of you.
Thank you. Please join me in thanking our panelists, and the session is now closed. Thank you.